This is Japan, the third largest economy in the world, and could be among the most significant nations in terms of global economic growth. Economist and Nobel laureate winner Simon Kuznets says there are four different sorts of economies in the world. First is developed economies, second is underdeveloped economies, third and fourth Argentina and Japan. This was a rather ironic way of stating that these nations have never actually adhered to the prevailing opinion of how economic systems should function. Argentina has a different situation, but some economists are beginning to postulate that Japan is quite common. Simply put, it is innovative. The nation has stagnated for 30 years and has not seen significant growth since its peak. The Japanese government was the first to implement economic measures, such as quantitative easing, negative interest rates, and ongoing deficit spending to overcome this stagnation. Unfortunately, none of these has been successful, and Japan's economy seems to be doing worse with every year moving forward. I'll be breaking down exactly why this is in today's video. Ladies and gentlemen, you're watching Financify, the best channel for helping you understand global economics and finance. Make sure to like and subscribe for more amazing content. And without further ado, this is the collapse of the Japanese economy. It was about midway through the 1980s when Japan's modern economy got its start. At this point, the nation had completely recovered from World War II's effects and transformed itself into a global economic powerhouse that rivaled the US. It was producing everything from cutting-edge technology to affordable, dependable cars. The ability to focus on high-quality manufacturing while relying on other countries for raw materials, food, and anything else that would be challenging to manufacture within Japan itself was made possible by a new worldwide movement for free trade. America and other nations excel at agriculture, but fall short in the production of consumer gadgets. Japan, on the other hand, excelled in manufacturing consumer electronics, but struggled with food production. Free trade meant everyone would have access to more food and electronics if both nations concentrated on their strengths and engaged in open commerce. The economy was booming, and most Japanese citizens had witnessed huge improvements in their quality of living throughout their working lifetimes. Of course, this couldn't remain forever. The US started to worry that nations like Germany and Japan, notably in the car sector, were beginning to outpace their domestic production. The conventional response to this would have been to impose restrictions on trade and slap a tariff on every Japanese automobile and video recorder that reaches American land. Then, all of a sudden, American goods will once more be cost competitive. However, the issue is still far from being resolved. If America imposed trade restrictions on Japan, Japan would probably return the favor, resulting in a loss of sales for American exporters. Additionally, it would imply that Japanese and American citizens would suffer because they would be compelled to purchase more expensive goods from producers who had been artificially shielded from international competition. So, some compromise was required. The nations came up with the Plaza Accord, a scheme to artificially devalue the US dollar in comparison to the currencies of Germany, France, the UK, and Japan. Americans would have less power to purchase products created abroad if the dollar value dropped. Still, people in all of these other nations would have the greater purchasing power to buy products made in the United States. As a result, American companies would be more competitive at domestic and international levels. For the Americans, it's not a bad deal, but why would Japan, a nation that relies largely on exports, consent to such a thing? Well, they didn't have much choice, really. You see, if Japan had not accepted this agreement, American manufacturers' lobbying efforts would have forced the American government to impose trade taxes on Japanese goods. For Japanese businesses, this would have been worse than a specific change in foreign exchange rates. Additionally, it would have been detrimental to all of Japan. Sure, they exported more to America than they imported, but the only things that America needed from them were expensive home theater systems and cheap vehicles. In contrast, Japan depended on America for food and a large portion of the raw resources used to make all the things it exported. Manufacturing in America became more competitive, while costs fell in Japan. Japan was able to go on a shopping binge with its new and more valued yen as the Japanese yen increased value. The nation's populace purchased everything, even American firms and holidays. Japan had put in 4 decades of hard labor as an industrial workshop and had prospered on its own, but the Plaza Accord made it wealthy. The relative worth of the money used by the Japanese people increased by more than double in just 3 years. Tokyo was the world's capital of work hard, play hard, and in the late 1980s, $50 billion were charged to Tokyo's corporate spending accounts in 1989 alone. This significantly impacted the economy. City centers and real estate experienced an unprecedented increase in value. The Central Bank of Japan cut interest rates as a preventative move to lessen the impact of lost exports. exports, which instead served to stoke the fire. Many people feel that Tokyo was destined to become the new global hub, and had a few things done otherwise that might not have been incorrect. Unfortunately, as you probably know, the 1980s surge did not persist indefinitely. Instead, it signaled the start of stagnation. Japan faced many challenges due to the early 1990s stock market and real estate meltdown. Now that the residences were only worth a small portion of the mortgage, its banks stood the risk of homeowners defaulting on their mortgages. The same issue affected companies in Japan as well. People had just witnessed the overnight loss of their net worth and, in many cases, were still burdened by the terrible debts incurred to support the excess. Consumer spending plummeted as the consumer culture soon returned to modest frugality from debaucherous luxury. The responsibility of caring for those who were no longer contributing to the economy that sustains them fell to younger workers and social programs as a result. The Japanese central bank repeatedly lowered interest rates throughout this time in an effort to stimulate the economy, but it had a very limited effect. In response, the central bank felt an increasing need to experiment with new economic stimulus measures. In their toolbox, quantitative easing was the hammer that could hit the hardest. With quantitative easing, a central bank prints money and then uses it to purchase assets on the international market. Normally, this would be government bonds, but in the case of Japan, the central bank embarked on a buying binge of pretty much anything it could get its hands on, including shares and corporate bonds. The Japanese central bank is currently the sole owner of most of the Japanese company equity. The purpose of this strategy is to give the person selling these assets immediate access to funds. If the bank purchases government bonds, it gives the government money to use for social programs or the construction of roads. If the bank purchases corporate bonds, it gives corporations money to use for the construction of new factories and offices. If the bank purchases shares, it may very well be directly providing regular consumers with money to spend in the economy. Why then did this fail? Inflation in Japan has stayed persistently low despite extremely low interest rates and quantitative easing. This is a factor that some economists say should give us comfort. It is improbable that sustained low interest rates and quantitative easing will lead to hyperinflation in our own economy if they don't produce any inflation in Japan. So, is this fair? Or is Japan unique in this regard? There are a few grounds to believe that the situation in Japan may differ from what is currently being felt throughout the rest of the world. The time frame comes first. Instead of the previous 3 decades, the U.S. has been engaging in significant quantitative easing over the last 2 years. Cash infusions should be spaced out to give players in an economy more time to respond. It probably won't be a big concern if the money supply doubles during the next 20 years. The money supply might be doubled during a 2-year period. The supply side of the economy is the second factor. The only significant difference between Japan's production capacity today and what it was 30 years ago is its aging population. For instance, if there are 5 loaves of bread, then each loaf should cost $1 in an economy where there are $5. Each loaf of bread should continue to cost $1 even if the economy now has 100 loaves and $100. There is no reason to anticipate a rise in prices if aggregate supply rises along with the money supply. On the other hand, today's supply has been severely disrupted in the majority of nations worldwide. We've become accustomed to things like empty grocery stores and waiting lists. The Japanese business and consumer cultures come last. Since the workforce is elderly and the corporate ladder is populated by people who have worked for their company for decades, asking for a raise is extremely taboo in Japan. It is also harder to move employment for a better income. This indicates that since the 1990s, disposable earnings have essentially stagnated. In contrast, workers in the U.S. are far more vocal about seeking raises, promotions, and new employment possibilities. And you can see that personal disposable income has grown significantly throughout the same period. The Japanese consumer, on the other hand, is extremely price vigilant and demands steady prices. The same kind of fiscal responsibility extends to corporations as well. The first thing American businesses consider when they receive a significant infusion of cash is how to reinvest it in the company. Since they are those firms' largest investors, and they are making a lot of effort to provide them cash, the Japanese central bank must find it extremely frustrating that Japanese companies have historically preferred to simply give that money back to their investors. Okay, let's rank Japan as the 3rd largest economy on Earth now. When you consider that Japan has had this amazing GDP of little over $5 trillion for close to 30 years, it is astounding enough on its own. Additionally, with little over $40,000 per person, GDP per capita is also very robust. It is a technologically advanced economy as a result, yet it still lags behind nations like the US, Germany, and Australia. Famously, growth has been very subpar. Since the 1990s, the economy of the nation hasn't actually experienced sustained growth. The good news is that it isn't reversing course. Finally, when it comes to manufacturing, Japan produces everything from top-tier automobiles to some of the most valuable media properties in the world. Another economic giant that has earned itself the workshop of the world is China. with historic economical growth and a booming population. It's no wonder they're the second largest economy in the world. But when you take a closer look into China, you'll be met with an economic horror show unlike any other. Watch this video here to find out what's happening in China.